welcome to Bazaar Ki Baat. In today's episode, besides a regular market update, we have two very interesting topics for discussion. First, we will be talking about how you should be thinking as an investor in the current markets, and if there is any change that you should be bringing to your investment portfolio. And then we will be talking about a category of conservative mutual funds that continues to be very tax efficient. But anything that we discuss on this presentation today is not an investment advisory and is only meant for education purposes. Welcome, Kshitij. So Indian blue chips recovered from their January losses. S&P BSE Sensex has gained 1.2% in February. Mid caps continue to do better. But small caps, I think, have taken a breather. They have lost ground up to 1%. So what do you have to say about the markets?
So I think the positive move which we saw in the large cap was largely due to the reason that the FPI selling slightly abated. We SBI turned net buyers in February, at least in the later part of the month. We saw some respite from selling, and they were net buyers of close to 1,500 crores. Another reason which supported this positive move was the strong corporate earning results, and we will probably talk about that later. Uh, uh, my sense is investors from now on, I think the next big event is general elections in May 2024. But I think the probability of a very large surprise is very low. So from that sense, I think from here to election, I don't see a very large trigger, at least domestically.
Right. But as the market is trading at an all-time high, the question keeps coming back to valuations, that the markets are
Right.
very highly valued. Do you think there are any concerns there?
So frankly, no one knows if the market will move up or down in the short term, even if it's undervalued or overvalued. I think that movement cannot be predicted. But if we talk only about valuation, we can probably look at the data. I think in order, probably, I would say small caps, sorry, mid caps are the ones which are most heavily valued, then small caps, and then large caps. So I think mid cap is the one which is probably has the most overvalued valuation, if in comparative sense. But if we look at large cap, last 3 year Nifty returns have been close to 14% CAGR, which is not so away from its normal average when we are seeing a nominal GDP growth of close to 12%,
Mhm.
right? It is bound to have some plus minus 2% here and there from the nominal GDP growth. 14% is not very away from the normal. Mid cap, small cap obviously have outperformed Nifty, but at least after COVID, but their earnings growth have also outpaced the large cap. So it's not very off from that perspective. Uh, we are also, if we look at P, which is the simplest measure of looking at valuation, price to earnings, the Nifty P is very close to its 7 year average. So it's way off from the highs we saw in October 2021. So from there on, I think the P is in that 2020 to 23 range, been trading in that range. So not very off from the last 7 year average. See, long-term averages are probably are not a right indicator for Nifty because the constituents have changed a lot. So now we are in a way which it's heavily dominated by banks, or for let's say for example more new age companies which have slightly higher P's as compared to utilities. So maybe a long-term average may not be the right benchmark for Nifty P. Uh, Another thing which helps me say that we are not so overvalued, or probably which will support the market, is that the FPI selling, as I said, has abated. Uh, and the story of this probably last 5 6 years is that the SIP contributions continue to move higher. So that will continue to provide support to the market. Further, I believe that we are in a very positive era from a macro fundamental perspective. Especially if you look at, you saw the recent GDP numbers, which was completely above expectation by most of the economists. But so in my view, the biggest advantage I think is coming from that CAD being under control or current account deficit falling, especially how
Mm-hmm.
so if that one deficit is under control, that and we are also growing, then I think that thing augurs well for the country.
Hmm. So macroeconomic wise, we do look strong. Anything particular to note in the sectoral performance?
So on the Q3 or the December quarter earnings, Indian corporates ended on a strong note, as I said earlier also, largely on account of margin expansion. Though we are seeing slight, I would say, slowdown on the top line, right? So revenues are slowly and are not growing at that similar pace as the profit growth. I think if we look at various sectors, we are seeing domestic cyclicals like autos and financials doing well, along with global cyclical like metals and oils and gas. They did well in terms of corporate earnings. IT, I think, continues to have marginal decline in earnings. FMCG, especially the staple FMCG or the or which are heavily reliant on the rural market, are the ones which are struggling. If we look at just the number, I think BSE 100 or Nifty, I think earnings grew by 13% YOY. So if we look at this 13%, so if the earnings are growing by 13% and if Nifty grows by 14% CAGR, I don't think there is any problem of valuation.
Hmm. All right.
Yeah,
So let us keep watching the market. I think this year is going to be an interesting year for all the investors to capture some learnings. And meanwhile, let us move to our first topic. And a lot of you have been asking us if this is a good time to book profits or should you invest in equity if you have idle cash. In our perspective, the answer to this is pretty straightforward. The investment portfolio that anybody makes should be based on one's time horizon, risk appetite, and goals. And any change or rebalancing in the portfolio should only be driven by two things. Either there is a change in the goal overall, or there is a significant change in the asset allocation mix. And an asset allocation approach makes these decisions very, very easy. So, what can happen over time when we mention asset allocation mix? What we mean is that over a period of time, what can happen is that you may get over allocated or under allocated to your target allocation. And this impacts you in two ways. One is that it impacts your portfolio returns, and second, it also impacts the kind of risk you are taking on your portfolio. So, periodic rebalancing helps to manage both these factors. But for an investor, there are two decision points that drive the rebalancing decision. One is the frequency of rebalancing, which is how soon should you rebalance your portfolio? Should it be quarterly, 6 monthly, annual? Normally, we suggest don't do it too often, but we'll come to the ideal rebalancing frequency in a bit. The second is what at what level should you rebalance? What should be the threshold from the target at which rebalancing should be triggered? So, Kshitij, you have performed this analysis with some data, right? So, while
right.
I have given the gist theoretically, can you help us understand your observation in terms of how does it look numerically?
So this is the data which we prepared for one of our clients, and I don't think this data we have a very so it's more of a data to prove up to actually showcase a point that how it is beneficial, though there can be versions of it which may so the return probably is not the idea of asset allocation, at least and when you look at data it will come out that the reallocation has actually contributed a lot of returns, but I don't think that's the idea which we are trying to drive. What we are trying to drive is that it the asset allocation when you shift rebalance a portfolio, it not only helps you reduces risk, but also what it does is it kind of behaviorally helps you to continue with that portfolio. So I think that that's the bigger
Hmm.
advantage. So what we did is for this analysis is that we took the actual returns from 2006 to 2023
Hmm.
for large cap, mid cap, small cap, gold, and domestic debt. So domestic debt, we have taken CCL bond total return index as proxy. So we assumed we took just one assumed the portfolio which is 60% equity, equally split across market caps, plus 10% gold, plus 30% debt. So that's what we assume. That's our target allocation. It can vary across for different kind of risk appetite or different kind of goals, but just something which we decided to showcase a certain point how rebalancing can help a portfolio achieve its mandated target. Now, first we calculated in case there is no rebalance, right? So we started in 2006 with these 20, 20, 20 across different market caps, 10 rupees in gold and 30 rupees in debt, right? So that's the split of the 100 initial 100 rupees at 2006. So what we saw is that in that case, the equity allocation moved in the range from 44% in 2008 end to 74% but in 2007 end. So a huge kind of miss from 60%. There was a large change and in these years, and the allocation at the end of 2023, as in by the end of December 2023, the allocation changed from 60%, 10% gold and 30% debt to 70% equity, 12% gold and 18% debt. So kind of it
Hmm.
varied across the time period and finally ended up at 70% equity, just driven by how the portfolio has performed, and no intervention in between. What we saw
Hmm.
is that we had a maximum drawdown of 40% in 2008. So 100 rupees invested it at 2006 beginning in that portfolio grew to 666 rupees. So basically close to 6.6x returns in 18 years,
Hmm.
which is okay. I'm not, again, I'm saying not return probably is not the focus here. We what we did is we took a second case and what we said is that we will rebalance the portfolio annually. At least we will relook at the portfolio annually and rebalance it if the target allocation for any asset class, equity, gold, or bonds, moves plus minus 5% from its initial weightage, which we have decided. So let's say
So your
60%.
frequency, so your frequency is annual, and your threshold target threshold is 5%.
Right, right. So either up or down, we will rebalance it to the original target allocation. If any of the asset classes has some movement, we will rebalance the whole thing to the target allocation, right? So what we saw is that rebalancing happened not every year. We only had 8 instances of rebalancing. So just to look at it, we only touched our portfolio 8 times in 18 years, right? So not a very large churn. I think a very minimal churn. Uh, the maximum allocation, obviously, for an equity was between 55 to 65%, right? And this is at the end of every year. So basically, after rebalancing, I'm saying. So it may have increased and then we rebalance it to back to 55 to 65%. 100 rupees of portfolio at the start of 2006 grew to 1004 rupees, so close to 10x growth in 18 years. And I think this is expected because you are what we are doing is probably when it becomes over allocated to equity, you're shifting to debt. And when it becomes when in a sharp drawdown in equity, you are probably reallocating from debt to equity. So this to somewhat extent this return was expected, but there's still a large difference between the first case and second case. And the one biggest advantage was that the annual drawdown also reduced to 27%, right? So it's so the from 40% to 27%, and I think the drawdown was largely in 2008. So both the cases the drawdown was in 2008. So one interesting incident, just for the sake of it, is that we saw rebalancing happening in 2014 due to the increase of exposure in debt. So basically, that outperformed in 2018 and 2014, I'm saying 2014, and as we have pointed out in yellow, I think that rebalancing happened just because debt had crossed that threshold. Also, one thing to note here is that we have not considered taxes and transaction costs, so be mindful of that. So any rebalancing, if it happens too often, will probably hit you on the taxes and transactions cost side. Uh, so here, obviously, we are only doing rebalancing 8 times in 18 years, so it's not so often. Just for the sake of it, if we take this threshold from 5% to 10%, the rebalancing even drops to 5 times in 18 years. So I think that's also acceptable. It just depends on your own comfort. And My sense is there are other ways to do it. Rebalancing people, I think there are what I think from a target allocation. If you, let's say, people do it like percentage of your target allocation. So which is also a very interesting way to do it, is that you don't keep a threshold as fixed for every 5% for each asset class. You say if the asset if that asset class target allocation is 60% and it moves by 20% from that, I will reallocate. So 60%, 12%, every 12% move, I will reallocate in equity. And similarly it kind of, what it does is, it doesn't equate every asset class because the weightages are different. So from 10%, you will probably reallocate if let's say 2% move happens in gold, so you will probably reallocate back to everything too. So there are ways to do it. I think one thing to very be careful is that you don't look at it too often, because if you look at it too often, there are chances that you will be whipsawed, and there are transaction costs associated with it. One easy way I think people in India can do rebalancing every year is that utilize your 1 lakh long-term capital gain tax-free limit. So within that threshold, I think people should book gains and reinvest if they want to. Uh, this is one thing I think which we need to again say, that this is a theoretical exercise which we did here. Sometimes it's just behaviorally difficult to do asset allocation. What we wanted to do here is to drive a point by showing numbers, that why rebalancing is so important, considering anyways we are at all-time highs, and there will be a time now that people should look at rebalancing their portfolios so that they can probably protect their gains. So that's also a part of biggest advantage of
So my key takeaways, I think Kshitij here are that, especially at market highs, I think rebalancing gives you that mental comfort, of being in your comfort zone in a risky asset class. But I think what we don't see is, in markets like 2008, people increasing equity allocation. That is not something that we see very often. We got a glimpse of it even in 2020. Not a lot of people increase their equity allocation in March, April 2020. So I think that's a key takeaway, that if there is a massive correction in the equity markets, I think that becomes a very, very attractive time to re-look at your allocation and infuse money into equity. And the other way around is also true. So thank you, Kshitij. I think this is going to really help our viewers take some very concrete actions on their portfolio. And let us now move to our second topic, where we are discussing about a certain category of mutual funds. So last year we saw a change in the way gains from debt funds would be taxed. And this, in a way, eliminated the relevance of a few categories of mutual funds for some investors. So, welcome, Vikas. Good morning. Can you throw some light on what these tax changes were?
Hi, Shruti. Like you mentioned, last year, this was a major change that we saw in taxation, and this had actually created a lot of vacuum for investors who were wanting to do debt allocation, because debt as an asset class on a post-tax basis had become quite like less attractive. So what was happening is that there was a clear vacuum because we don't have many places where we can securely park our assets. Even for retirees, there was nothing except some government schemes, But even in that, the after tax returns are not like sheltered. If you are in a tax slab, so there was nothing like that. So last year we saw that indexation was taken away from debt funds, and debt funds as a category became less attractive.
Mhm.
And there was one regulation which was not exploited by a lot of funds, and now we have a fund which has tried to exploit it to an extent. So it does not remain the same. So I'd not say that, because the earlier what was happening is that everything was debt, so the risk element was lower. But yeah, now we have a category of fund which has slightly higher risk, but definitely it has a use case. So generally what happens is that we don't want to talk about individual funds or individual stocks, but over here also we're not trying to recommend something, but we are trying to explain that there is a use case of a product which, if it suits you and if you understand the risk, this can actually add value. And why we are discussing is, the reason is also because this will help you in the long term. So the benefit also do not accrue if you do a short term kind of thing. So this is not a
Right.
short term money making opportunity, but yeah, definitely if you're looking at long term, this will add value. So we'll throw some light
Right.
about that.
So, Vikas, I think you're talking about the recent launch by Parag Parekh, Dynamic Asset Allocation Fund, which is, I think, a hybrid category where investors can take the indexation benefit. So, can you tell our viewers more about this fund, and also tell us if there are more funds in this category that our viewers can, think about?
Yeah. So see, this is generally a hybrid category. A hybrid category is a fund where a fund manager can invest in debt, equity, gold. So there are a lot of funds in the market which do that. So we have like a balanced advantage fund, which is typically trying to time the markets. So the if you see the commentary from these kind of funds, they're saying that we'll try to time the market. When the market falls, we'll try to increase the equity allocation. When the market is up, will try to decrease the asset allocation. So this is predominantly a balanced advantage fund. So there are funds like aggressive hybrid funds, which will again try to maintain a 65% equity exposure and 35% debt exposure. Then there are funds which are equity savings. Again, in that, a lot of funds have now moved towards equity taxation. So what they do typically is that they keep some equity allocation. Over here also, they're trying to time the market. So the predominant idea of a lot of funds, even there's one more category which is multi-asset fund. So all these three, four category are predominantly hybrid funds, but the prime objective of these funds are to time the market. Now with timing the market, what happens is we don't know when the market may take a lot of time to recover also. So maybe the valuations are cheap, maybe there's a structural change because of which that timing may not play out in the near term. Maybe it may take 1 year, 2 year, 3 year. So what happens is that is a different kind of risk appetite that an investor has to play if he's playing those kind of funds. With this
Mm.
category, which is a dynamic asset allocation fund, in this category also, this specific fund has clearly mentioned that the objective is not to time the market. So this makes it a slightly more different fund from the other funds in the hybrid category, that the fund is not trying to time the market, but it is looking to maintain a specific kind of equity exposure, that too in a specific kind of securities. So what happens is, where we get comfort about this fund is that when we saw that ILFS's crisis in 2018-19, that time when they had launched a fund, they were very clear that they don't want to take credit risk. So in this fund also, what you'll find is the credit risk is minimal. So most likely what you're taking is AAA rated government bonds. So the credit risk is taken care of. Also, they're not very, very aggressive on the duration side also. So if there is some opportunity, they'll play, but it is not that they're trying to again do very, very high duration. So on the
Mm.
debt side, this is the portfolio, the how they have created. On the equity side, they generally invest. So we have a track record from like PPFAS conservative hybrid fund, where we have seen that again, the idea is not to chase growth stocks and all. So they are trying to again chase stocks which have value, which is high dividend yielding stocks. So this makes the portfolio quite robust in terms of risk. So the portfolio is more about downside protection and trying to like generate a return which is inflation beating. Maybe you'll not beat it by a high margin, but definitely you can protect your capital and beat like on a post-tax basis inflation. So that is the predominant idea with which this fund has like started its investments.
Mm. And we also spoke about, this becoming a category which is more tax efficient, right? So, can you explain how this category, is superior over other debt fund categories from a tax perspective?
Yeah, so now what happens is that if you see fund A, so now if you are doing any kind of like debt investments, what happens is that your returns are taxable. So in this case, if you see if you have invested 100 rupees and if you are generating 8% kind of return, you generate 36 rupees in a 3-year basis. That is your capital gain, right? Now you are taxed at slab rate. This we have assumed as 30%, but for some affluent clients with whom we work, they are even taxed at 40%. So what happens is your net return, which you get in your bank account, which is accessible to you, goes down from 8 to 5.4 and even say 4.8 also in certain cases. Now what happens is that if you are investing in a like dynamic asset allocation fund, your tax, you get indexation benefit, which was earlier available to other debt funds. What happens is that your tax, which is 36%, like your gains, which is 36%, you get inflation benefit, which is generally in the range of 5-6% in our economy. So 15% returns are actually not taxed. And you are being taxed only on the incremental return, which is 21 rupees that you made, and on that also 20%. So what happens is that you can see that on a 3-year basis also there is a significant difference of like 5-6% more that you make out of your money. Also,
Mm.
there is one more interesting thing when I was like going through other schemes and all. So when you see the returns of like equity saving schemes and other like hybrid funds, what happens is that their returns are also in the range of 8.5. Now, if you see that if they're taxed at say 10%, then your post-tax returns are 7.2%. If similar, say suppose they are also generating 8%, and here you are getting taxed at 7.37%. So what I'm trying to say is that if a fund which generates 9-10% return, they can only beat it on a post-tax basis. But a fund which generates similar kind of return with equity taxation also, this becomes
Mm.
superior.
Right. So I think the key takeaway is that if there is a category which has equity allocation between 35 to 65%,
Yes.
then the indexation benefit prevails. Currently, in this category, we have, this is an interesting kind of a fund which has been launched by Parag Parikh. But because you mentioned about 35 to 65% allocation, and you have also mentioned that part of this allocation is through covered call derivatives, etc. But the core equity allocation is going to be much lower, right?
Yeah.
So this is not really a fund where you might be seeking long-term wealth creation. So
Yes.
then, who is it suitable for?
Yeah. So what I was see what happens is that people first I think we should see that who should not invest. So what happens is that whenever we talk about funds which are lower risk, people think that it will have a very linear kind of progression like an FD. So this is firstly not an FD. Obviously there would be some NAV movements, and you have to first understand that this is something which comes with any market link product. So people who are investing in FDs and want FD risk, this is certainly a no. But yeah, if people who are looking to invest for say 3 years, 5 years, one use case which I was able to like suggest someone whom I met. So what happened is that there was a person who was like retiring in the next 5 years. So what happened is that he said that after retirement, I'll need some monthly outflow also. So what I said is that you start building some corpus over here. After 3 years, what happens is that this corpus becomes you start getting indexation benefit, and after that if you start taking out some money from this, what happens is that for your like till the time you're drawing, all the money that you get as monthly withdrawal also is tax efficient. So this
Mhm.
is one particular use case which like he was actually very happy because he needed some cash flows also. So this is
Mhm.
one category of people who can look at it. Another category who want to do like say people like we discussed in the earlier thing, Kshitij mentioned that people have to do asset allocation. So this is a very good investment for an asset allocation perspective where you're trying to do
Mhm.
10-20% debt allocation. That debt
Mhm.
allocation may not be redeemed fully or may need to be redeemed after 2 years, 3 years to rebalance. Now, what happens is this again becomes a very good investment vehicle to do your long-term like debt allocation. So these are some instances. Also, investors when they sit with their like planners, when they sit themselves, they have to find like the perfect suitcase, like perfect case where they can invest in this fund. And anybody who's looking to invest for 1 year or 2 year, then again, this is not the fund. You are better off investing in
Mm.
an FD or a liquid fund. So these are some use cases that I feel that the fund definitely solves.
Mm. I think I can also think of one use case. I was talking to somebody who was looking to buy a property in a couple of years, and they wanted to
Yeah.
park around, a 1 2 CR for 3 to 4 years. So I think
Yes.
these kind of categories
Yes.
of mutual funds, which are relatively lower risk,
Yes.
do suit them as well.
Yes.
And specifically, when they compare to their high tax bracket and bank FDs as an alternative. So thank you so much, Vikas.
Thank
I
you.
really hope that some valuable takeaways have been taken away by our viewers. And stay tuned for our next episode.